when you're working and saving money, your investment strategy is completely different when you're retired and you're spending money.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me. How you doing?
Doing pretty good, Cory. It's been, really busy at Falcon Wealth Advisors. We've been very fortunate. Got a lot of new clients that we're working with. And so as our current clients know, that we are somewhat selective in who we choose to work with, but we've met some really cool, interesting people. So I'm real excited to continue to grow our practice and help more people. That's what's new with me. And the house, I got to have you over. It's completely changed from when you saw it.
It's been a couple months.
Yeah, I got wallpaper on the ceiling. You ever think of that one?
You know, you are the second person that I know who put wallpaper on a ceiling this year. I had never heard of that before this year. How's it look?
It looks amazing. I never would have thought to do it, and it looks awesome. So it's in our library, and I want to put a TV in the library, but Rachel won't let me because otherwise that'd be my favorite room in the house now. It's that cool. The library's turned out to be really cool.
Just get rid of those books, put up a TV, you'll be good to go in the library, right?
Awesome. We have a fireplace in there. I could watch the
It is a
Chiefs
nice room.
game. Einstein in there. I could watch the Chiefs game, put a fire on, look at my wallpaper on my ceiling.
That's right.
It could be all good. What about you? What's new with you? What's new?
Not too much. Our daughter turned 2 months this past weekend, Jake. Kind of crazy. It's like a blink of an eye on one hand and a lifetime on the other, but all is well. We're just kind of rocking and rolling.
She'll be driving a car in no time, Cory.
That's right. That is right. But one day at a time, we'll get there. But all is well. Not too much else, I don't think, Jake. Just humming away here at work, like you said.
Good. Well, I wanted to thank our audience. Our subscriber count continues to grow. Yeah. So if you're watching or listening to Upticks, please give us a 5-star review, a thumbs up, like, and share our content. The whole purpose of Upticks is to enhance financial literacy at scale, and we can't do that if our content isn't shared out there. And also special thanks to one of the listeners who emailed in a question. So as a reminder, we do love to hear questions, comments from our audience. If you have anything for us, please email our producer, Luke, at falconwealthadvisors.com. And Luke will make sure that your question gets addressed live here on Upticks. So Cory, well, maybe I'll read it off and I'll let you talk about it. How about that?
Perfect. Let's do it.
All right. Here was the question. More of a thought and a question, but it has recently come to my attention that there is a Jackson County, Missouri senior property tax credit program. That's a lot, which freezes an eligible senior's real estate property tax for primary residence at the 2024 amount. Information and form on this program is easily available online. I knew nothing about it until a neighbor mentioned it. What are your thoughts?
So the bill that was passed, the legislation, Jake, I think it was last week, expanded eligibility for this program. So what it did is it removed, basically, if someone is Social Security age eligible for benefits, whether or not they're collecting it, they can ultimately have their personal property taxes frozen at the 2024 levels beginning next year. But there previously, Jake, was a cap on the value of your home and your income to be eligible for this program. But this Missouri bill actually removed that. So anyone in Jackson County that is 62 or older, that is a homeowner, is their primary residence, would be eligible for this.
So that's age 62?
Correct.
Right. So age 62, eligible. Pretty cool. And then they just got to go online and fill out a form, right?
Yes. Yeah. Through Jackson County, there is a senior property tax credit program that basically outlines who's eligible, the application process, and what needs to be done. But what's interesting about this is there was
a little light bulb moment there. So
again,
if you're 62 or older,
and
you live in Jackson County, Missouri, When should you not fill this out? Shouldn't everybody that's 62 or older be doing this?
Thinking this through, Jake, I am not sure why someone wouldn't.
Hold on, real question. I know you did some homework on this. If tax, which I doubt this would happen, but if tax rates go down, do they get the, yeah, like they're ever going to go down. But if they go down, would the person get the lower assessment?
Yes. Yeah. In fact, they have outlined, Jake, that if your home value decreases while you're enrolled in the senior property tax freeze program, state law in Missouri now specifies that your tax amount will automatically decrease to correspond with the lower value.
All right. Excellent. So good. Well, thank you for the listener. So I think it's a little bit of a no-brainer. You always want to run this by your CPA because it is technically a tax question. However, it seems like there's a lot of opportunity there for our clients that are 62 or older to be able to lock in what currently or used to be a variable, right? So a variable expense is your property taxes, which would certainly impact your financial plan. But now you have that ability to freeze that so that we can do more financial planning, more budgeting work for you. So you know that that expense is not going to grow with inflation and home prices. So good. I'm glad the listener brought it up. And I think it's an important topic. Anything else you want to add before we go into our headlines?
The one other I would add around this though, Jake, is the senior property tax credit that we're talking about is one thing, but there was also legislation actually just last week from the Missouri State Tax Commissioner that talked about rolling back personal property tax values for all homeowners in the state of Missouri as a consequence of, really all of the issues that have been relevant for the last year or two. So there's still some questions that are unanswered around that. And I think that will apply to those folks that wouldn't be eligible for the senior property tax credit because we're kind of talking about two different things, but they're very intertwined. It'll be interesting to see how it plays out. But I think the reality is a couple years later now, but it was recognized that the way increasing the property taxes was handled was pretty sloppy. And the state tax commission actually came in and said, this wasn't done right. We need to roll back to this level.
Good.
Yep.
Excellent. Okay, perfect.
All right, Jake.
Let's take us away here.
Let's play ball. Millions of taxpayers call the IRS for help. 2/3 don't reach anyone.
Yeah, can you believe that? So millions. Have you ever tried to call the IRS, Cory?
Yes, I have, and I don't know if I got a hold of anyone. I probably hung up before I did.
Yeah, I think probably the same for me. I'm not a very patient guy, and I remember being on hold for a long. Maybe I got a hold of someone. I don't remember either, but. Literally, this article says millions of taxpayers call, and 2/3, that's a lot, don't ever talk to anyone. So the point is, the IRS has hired 7,000 people, and it still takes on average 22 months to solve identity theft cases. And they still have, Cory, 500,000 identity theft cases in their inventory. Now, this says hold times average around 10 minutes, which I don't believe. And it says some reps are super busy while others are sitting back with no lines ringing. Isn't that crazy? So
imagine that.
Some people are sitting there twiddling their thumbs and other people are just sitting there on hold. That's frustrating.
Doesn't make any sense.
Yeah, and the author of the article brought up a great point that rather than throw people at the problem, let's think differently. And my question to you, Cory, is if the IRS were a business, would it still be in business?
Since we're speculating here, no, would be my answer.
Right. No, because hopefully they wouldn't be a business that's a monopoly and there'd be other businesses to choose from. And the way that the IRS is being run is absurd. And I loved that point, though, because you remember when they said they were going to hire all these people and they were going to start cracking down on people that were cheating and not filing. Nothing's changed, and the service hasn't gotten better. So they just threw a bunch of probably unqualified people, or who knows, or maybe just assigned them to jobs that were not impactful. And instead, they said maybe they should change the way they do things, change their processes, change their systems, maybe invest in technology, right? Where they can actually improve their offering. And I still think that the IRS should send people a bill. This is what you owe. It's so backwards that I have to magically figure out what I pay the Uncle Sam. Where else would you do that? We don't bill our clients that way. We don't say, hey, client, I'm going to tell you the rate, but you have to tell me what you owe me. Clients wouldn't pay me. So I just think it's crazy. And so I don't know. Again, this is above my pay grade. I don't want to work for the IRS. I don't want to work for the government. I'm just saying I agree with the author here that throwing people at the problem clearly hasn't worked.
Do you know how many IRS employees there are, Jake? I just looked this up.
Yeah, I saw you typing. Well, how many? I don't know. I have no idea.
Almost 94,000.
That's crazy. That's
Almost
crazy.
94,000. Yeah.
94,000 people?
How many are answering phones and how many are sitting in the back twiddling their thumbs? I would love to know that.
And let's be clear, I'm not picking on the employees at all. I'm not actually, because I get it. Like somebody hires you and they're plugging you into a flawed system. It's not your fault. I'm not saying the IRS, I'm saying they have probably really hard jobs. And they're probably, the people that do work for the IRS are probably pretty good at it. But you shouldn't need 94,000 people to do what they do.
To pick up a third of the phone calls that you get?
That's crazy.
You definitely don't need 94,000 for that, in my opinion.
Yeah, nuts. Anyways, all right, let's move on. What's the next one here? So, Cory, what should you do with your 401k when you retire?
Yes, this is something, Jake, that we talk with clients about all the time. Because a lot of clients we work with, they've built up money in their 401ks over the course of their career. So really what to do with it after you retire, the two primary options that were highlighted in this article and I think are relevant for most people is leave the money in the 401k or roll it to an IRA. And I thought the author here did a pretty good job of really outlining the careful considerations to make and really weighed out the pros and cons, Jake, really looking at it both ways. In a traditional IRA, for example, it's funded with pre-tax dollars. You have more investment options in all likelihood than you do in your 401k. You may have professional management, streamlined consolidated accounts, more flexible payouts in terms of tax withholding, et cetera. Leaving the money behind in a 401k, you may have lower costs. You may be able to access the money sooner at the age of 55, following the rule of 55, and just simplicity in terms of options. But I think, again, the author here, Jake, did a good job, but there's really not a right or wrong answer. There's not a uniform answer here, but it is an important decision. And I do think the key is to establish a plan and to work with a fiduciary to help figure out the right way to handle this. Because we work, Jake, with clients that do a combination of leaving funds in a rollover for accessibility and rolling funds into an IRA and ultimately fit it all into their plan. But that's something that we wouldn't be able to do if we weren't building out financial plans for clients. So if you're retiring and contemplating what to do with the 401k, just recognize that it is an important decision. Work with a professional. Fiduciaries at Falcon Wealth Advisors can really help figure out what's best for you and your plan.
Yeah, I think this is a good one. I think we should drill down on this a little bit because I think too many advisors, and there's big regulation surrounding this now. I think too many advisors will take clients' 401k and they'll roll it into an IRA and they'll put them in products that are more expensive than the products that they were in
their 401k.
Before in their 401k. And that's a problem, in my opinion. Now, just the product. Now, and then if you're paying an advisor a fee on top of it, like that's tough. So again, our preference is that we like to roll over the 401k, not all the time, like you said, but when we do it, we're not using products. So not only is the investment strategy typically different, we're also able to do more. If a client's approved, we'll trade options, and then we're doing our planning and tax planning and all the other services that we offer. So I think for a do-it-yourselfer, though, let's say somebody's watching our show, Cory, and they don't have an advisor. And if they're very familiar with the funds in their 401k, I don't think it's a bad idea to leave it in there. But the problem is, this is a big problem, though. This is why I want to address this a little bit deeper, is that when you're working and saving money, your investment strategy is completely different when you're retired and you're spending money. It's a completely different way to think about investing. Investment performance is actually very much different. Like for our clients, income, most cases, not every case, but income most times, though, Cory, is almost more important than the rate of return. Whereas when you're saving and you're using compounding, rate of return is probably more important than income, if you think about it. So again, if you're retired and if you're pulling income, if I can generate enough income in your account to satisfy your financial plan, then yes, we want to still hit your target rate of return, of course, but your target rate of return is less important. And I hope people can follow that. So like, if you need to pull 100,000 a year from your portfolio, if we can do that in dividends and bond interest, sure, we still want to make you 6, 7, 8%, whatever. We want to hit your target. But if we're generating the cash flow you need, I think that really provides a lot of value to people's lives versus when you're working, if you're generating 100 grand, but your accounts are losing money or they're not growing, that is actually not as important. So again, I just want to encourage people that saving and investing for one-day retirement is completely different for investing and spending in retirement. And so the money needs to be managed differently. And that's why we typically roll it over, if it makes sense with the client. And we do that because we are now setting up income strategies and withdrawal strategies. And sometimes we're able to do that, in our opinion, more effective. This is our opinion, more effectively than what perhaps a 401k investment menu will provide. And so I thought that, I think I read this article too, and I'm glad you shared it. And so, but the key with clients is to understand the pros and cons, know what you're signing up for when you're working with an advisor, make sure that their investments are different. If advisors are going to put you in the same investments in your 401k,
right? Yeah.
I don't know why you would do that, right, necessarily. And so, again, you just want to make sure you understand what you're getting into before you just roll it over. Good.
All right, Jake.
Hold on though. Shame on me. I was looking through this, Cory. We got to stick with you. I thought I had my notes in here. They're not in here. So I'm gonna tee another one up here for you. Look at this.
Okay.
This might be the Cory Bittner episode.
All right, the Cory Bittner show. I like it. We'll remember that one. Okay.
Here we go, Cory. We'll tee another up with your notes here. So, Cory, investors borrowed like crazy during the rally. Now they're paying the price.
Yes, this, Jake, was about leverage. And leverage is ultimately using borrowed money to amplify expected gain. So if you're borrowing money and you're expecting to increase your returns even further. The idea, though, is leverage, Jake. If someone is borrowing money to amplify their investment gains, that it can really turn in a hurry. And this article suggests that deleveraging, which is basically people unwinding that leverage, is the culprit behind a lot of the volatility that we've experienced in the markets this summer. And highlighting the yen carry trade, which has been discussed quite a bit too, Jake, which I don't think we need to get into all the specifics there. But my perspective on this was that with daily options expiration in the market and levered single stock exchange traded funds, where somebody can buy a fund that will have 3 times the return of whatever the underlying stock is. With all of this stuff in the market, investment products, what we talk about on this show, Jake, it is more important than ever to manage risk, which is what you're talking about when we were just highlighting the prior article about your 401k. Right? Chasing returns and managing risk are 2 very different things. We tell clients all the time, they've usually done the hard part. They've accumulated and saved the money. The goal in transitioning into retirement is to preserve it, to help grow it and generate income so they can live comfortably. All of that is tied in, Jake, to managing risk. So my question for you.
Go ahead. Yes. No, go ahead. What's your question?
From all of this, is there anything that has caused, Jake, more fear, greed, and volatility in the markets than leverage, than people borrowing to amplify their returns? Is there anything that has really had more of an impact? I can't think of anything else.
Yeah, I don't know. That's a good question. I agree with you, I think, because you're right. These 2X, 3X ETFs are so dangerous. And then if people are borrowing on margin or taking out home equity lines of credit and throwing it into meme stocks, it's so dangerous and risky, and greed is taking over, and it's not good. And so, yeah, I think, yes. So, right. You don't need to nobody, frankly, needs to do that. The people that do that are gambling, and you shouldn't be using the stock market to gamble. You shouldn't be using your retirement money to gamble. If you like the rush and the thrill of gambling, there are lots of other avenues that are far more entertaining than watching CNBC, right?
You're right.
I'm not much of a gambler. If I were a gambler, though, Cory, you know where I'd go? I go to the horse races. Have you ever been to a horse track?
No, I haven't.
Pretty awesome, actually. I'd go to the horse track. I'd go to Vegas. You can even do sports gambling in a lot of different states now. Do that with money you can afford to lose. By the way, let me be clear, full disclosure. I'm not encouraging this, by the way. I don't think anybody should gamble, really. Well, I don't think anyone should gamble with anything they can't afford to lose. And so, but again, if that is your thrill, gives you enjoyment, entertainment, maybe you do it with a bunch of buddies or girlfriends or guy friends, cool, that's your thing. But don't be doing it with your IRA. Don't be doing it with your Roth IRA. That's not why these accounts were created. These accounts were created so that you could have financial independence one day, and that you would no longer have to trade your time doing something you don't want to do for money that you need to live. That's why you should be investing in stocks and bonds.
Wait a minute, Jake. Just to be clear, you're suggesting that investing in perpetual crypto futures where we can leverage our returns up to 100 times is not the path to financial freedom? Okay. I just wanted to be clear. On what you were saying.
Not. And stop listening to your brother's, sister's, neighbor's dog. How about somebody got rich doing this? Yes, you know what? Somebody wins a lottery. Somebody wins a jackpot off a scratcher ticket. Somebody right now is pulling a slot machine in Vegas, Cory, and they are making money. They are.
Ding, 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 jackpot.
But that doesn't mean that's going to be you. And I'm not saying I'm not wishing luck on people, but I'm saying don't use your retirement money. That'd be like saying, Cory, I'm going to take my $1 million IRA and I'm going to go to Vegas and I'm going to gamble it. That's what you're doing when you're buying these leveraged ETFs and crypto and all this other nonsense. Like, don't gamble it. Don't gamble it. It's so stupid. And you're just hurting yourself and your family. Like, let's leave the retirement money for what it's supposed to be, and let's go gamble and get our thrills with that money. Maybe it's $20, maybe it's $200. Heck, maybe if you're rich enough, it's $2,000. I don't care, as long as you can afford to lose it. My issue, you know why I don't gamble?
Why is that?
I hate losing money. I hate it.
You work too hard for it.
I hate losing $20. I hate it. I just don't like it. And it was so weird how I've changed. When I was in my 20s, I played poker with buddies, right? I liked Vegas. I went to the horse track. I didn't have a lot of money. I still hated losing. But something happened, Cory, in my professional career where I started working a lot at doing as a wealth advisor. And I'm not going to sit here and work 60 hours a week to go blow it in an hour. I'm not going to do that.
Yeah, and frankly, you're giving people advice on their finances.
That's a hypocrite.
Yeah, right. You are. So I think I'm glad that you don't have that habit, Jake, and I don't either. But it's not about that habit. It's more about, what are we doing here? If someone is leveraging up their retirement accounts with the expectation of getting rich quick, just recognize that you might hear about the people that get rich, but the people that get blown up aren't going to tell you about it.
Right. Good. All right, Cory, let's go on. I think we got time for one more for you here.
Okay.
And shame on me. I swore, Cory, I had my notes in here, but I guess I don't. So shame on me.
You had some notes, but that's all right. What do you got next?
I don't think I do, though. Not on my other articles. So, all right. You got notes. So here we go, Cory. The 401k investors convinced that target date funds missed the mark.
I like this, Jake, because this kind of ties back into the first article where we talked about the 401k. This is all relevant and connected. So a target date fund is a managed portfolio of stocks and bonds that basically will recalibrate the mix between the two as people approach retirement. So this has become a really popular option in 401k plans. Somebody starts at a new job, they may pick the 2065 retirement fund, whatever it might be. But this article is highlighting and talking about the investors convinced that these target date funds don't work well, or they're not the right way for most people to be investing in retirement. And this talks, Jake, there's trillions of dollars now. Trillions of dollars that's gone into these funds. Vanguard actually said, I think that it was over 60% of the assets in 401k plans are in target date funds, which seemed wild to me. That's a big, big number. But they do hold trillions of dollars in assets. So the target date funds, though, the other side of the story here is that for some people, it's an easy way to get money invested. It's going to automatically recalibrate as you get closer to retirement, something for people to not think too much about. But the flip side to it is that, the cost on average, according to this article, was 0.68%, so just shy of 0.7% per year, according to Morningstar Direct. So almost 0.7% annually is the average expense on these, which is higher than a lot of other investment options in someone's 401k. Also, though, Jake, the desire for control over the level of risk that someone's taking, because a big point with these target date funds is that when people get closer to retirement, it really will de-risk the way that the money is invested, which may or may not be appropriate for their plan. And the level of risk that someone should take is ultimately being left to, an automatic fund in this instance. But lastly, they talked about how individual planning and investment goals that just aren't aligned with the auto calibrations of these target date funds. So my perspective on this, Jake, and I'd love to hear what you think, is that this is a way that people can start to get money invested for retirement. But the reality is the more money that people are accumulating, the closer that they're getting to retirement, probably graduating from a fund like this and reevaluating the right way to approach your whole portfolio is what I think is probably the right move for most people, or at least to analyze and explore that. What do you think?
Yeah, I don't like them. I don't even like them for the beginner. I know that a lot of financial planners will say that, like you just said, like if you're starting out, but the problem I have with the beginner, so someone in their 20s or 30s picking one of these cores, I think people get complacent and they get lazy and it won't get revisited. Because you're right. This is the issue. Like many of our clients, their portfolios aren't necessarily that conservative when they get into retirement. Right. Or some of them are more. So again, the target date fund has no idea about your situation. And
correct.
I think it's a little crazy that there's trillions of dollars that many people have trusted a mutual fund company to invest their money for them in a very specific way where they don't know anything about them. That's like
it's as one size fits all approach as anything.
Yeah, that's like saying that everybody when they're 60 years old needs to start taking insulin because they might be diabetic. Or even worse, like prednisone, right? A steroid, like where for some people they may need it and other people it may actually be hurting them. So that's like, again, it's basically putting everybody in the same allocation regardless of their financial situation. So again, it's basically like big pharma pumping drugs into people that may or may not need it. That's to me that's the best analogy of what a target date fund is. And I don't know why anybody would do it. And again, even a young person starting out, you can build an allocation.
True.
You can meet with an advisor one time, and they could give you so much information more than a target date fund could. And again, I think a lazy way is doing the target date fund. I think a target date fund is better than not investing at all. So don't get me wrong, but I just think that you are saying that you are choosing your very specific individual life to be treated like a generic situation. And I don't know how many humans like to be thought of as generic. Do you want to be called generic?
Nope.
Right. Or that you don't matter, or that your plan doesn't matter.
I don't.
Or that you and your daughter and your wife and your goals don't matter. That's what that when you do that, when you buy those funds, that's what you're saying. That doesn't matter. I don't think you would say that
there, Jake. But I think you're right because there's real people that were interviewed and highlighted in the story. One, for example, Jake, was someone who was only 25 years old, but she had a good point, which was, do I need this allocation to fixed income or bonds in my retirement account if I'm not going to retire for 40 years? Do I? Is that the most appropriate thing for me? There was another person in here, Jake, who's 61 years old, getting ready to retire. And he talked about how he saved in his 401k ever since he graduated college. He's put 20% away, has put himself in a good position. But he said, you know what? I have the next 5 years of planned distributions or expenses of my money not invested in the market. Why do I need to have target date funds if I know where my cash flow and distributions are going to come from?
Yes. Good for them. Yeah. They
Absolutely.
interview some good people. That's exactly right. And again, it comes down to their financial plans and what is specific to them and their goals and their family's goals. And I think that's a really good point. I'm glad you brought it up. So again,
yes,
I don't think people should be using target date funds generally. I think if you're doing it on your own, that's better than not investing. But again, you're not generic, right? And you're not cookie cutter. So don't allow yourself to be fit into this mold so these stupid mutual fund companies can make money off of you, because that's what's happening.
Right. Yeah, exactly. What about when you reach certain financial and life milestones? None of that's going to be taken into consideration here with the target date funds. And that how could you exclude that from your retirement planning?
Right.
Milestones. Financial and life milestones. That should be a crucial part of your retirement plan, not one that's not considered at all.
Right.
Yeah.
Good one.
And people reach different milestones at different ages.
That's right. You're absolutely right.
Yep.
Good article, Cory. Great job putting your notes in there. Shame on me. Next time I'll have some more content to share.
Shame, Jake. That's okay.
I thought
That's
I
all right.
did it.
This just proves, Jake, that you're not perfect. I know that Rachel thinks you are, and that me and everybody else here thinks that, but this just proves that you're human like the rest of us.
But I forgive myself pretty quickly. I'm already over it.
Okay. All right. We'll move on, right?
I'm already over it. So, well, thank you. I know that's all the time we have today. Thank you, as always, Cory, for joining me. And thank you all for listening and tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.